Hi there, welcome to A Market Call. Our guest today is Andrew Moffs. He's Senior Vice President and Portfolio Manager at Vision Capital, and he'll be taking your questions on real estate stocks and REITs. Phone number 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Andrew, always great to see you. Thanks very much for coming on the show.
Yeah, thanks for having me on.
Maybe we could put up a chart for the 10-year Canadian bond yield and the 10-year US bond yield. Particularly in the United States, that bond yield has moved up over the past few weeks. And of course, that tends not to be great news for the real estate industry. It increases borrowing costs, broadly speaking.
Yeah, broadly speaking, it does. But the other end of the spectrum is you have to think about what's happening with credit spreads. And if you look back from the wide spreads of 2023, credit spreads have contracted about 50%. So actually, we think it's a pretty conducive market for financing costs today. The market, simply put, is wide open for both the private market borrowers that have a good balance sheet and for the public market companies like the REITs who can access unsecured rates at levels much lower than the private market. So as a result, notwithstanding yields have gone higher and we've seen real estate stocks being sensitive to that, we think transactions will pick up in 2025, which could be a great catalyst for publicly traded companies.
Give us, we're going to be talking about what sectors you like, but broadly speaking, what type of real estate companies are you most interested in these days?
You know, broadly speaking, we think a sustained commercial real estate recovery is underway. We like sectors that can act both defensively as well as those that can have growth. Certainly the data center sector is a sector we really like. You have really compelling demand factors, no supply that can keep up with the insatiable demand there. We continue to like industrial warehouse. That's the biggest sector allocation in our fund. While there have been some slowing rent stats, we think the mark to market, i.e. the gap between in-place rents and market rents, is still very wide, and you have many secular demand forces going on that are positive to industrial fundamentals. So that warehouse space we like. There's pockets of residential that we're positive on, like manufactured housing communities, as well as grocery anchored shopping centers, very defensive cash flows at a time where you have the most compelling supply and demand characteristics fundamentals we've seen in many, many years.
Andrew, thank you so much for joining us today. We're looking forward to actually drilling into a sector in more detail than we often do on Market Call. Our guest is Andrew Moffs of Vision Capital. He's taking your questions on real estate stocks and REITs, and the number to call, you know it, 1-855-326-6266. We have an email from Tony. Tony is asking, what's Andrew's take on Brandywine Realty Trust, BDN, in New York? Just remind us what they do, please, Andrew.
Sure. Yeah, Brandywine is an office REIT. Their core focus is in the greater market of Philadelphia, about 3/4 of its portfolio, and another 20-odd-ish% in the Austin, Texas market. It's under $1 billion of market cap today. The stock's far off its highs pre-pandemic, traded above 15, around 550 today. Has a very high dividend yield, which is what attracts certain investors. Obviously, the office market has been a very challenged market broadly. Brandywine has some very good buildings as well as some commodity buildings. Commodity buildings are trading at big discounts today to what they used to trade at before. I mentioned a very high dividend yield. It's over 10%. That's because the company currently pays out more in dividends than it currently earns. Why is that? Their occupancy levels have come down. They have a very large leasing that they need to do in a large development pipeline. These are good assets. However, it's going to cost a lot of capital for them to lease them up. So a lot of people are calling into question the sustainability of that dividend, and hence it trades at such a large discount. As a result, not a stock we're focused on today. If we're looking in the office sector, we're looking for names that have trophy buildings, compelling supply and demand fundamentals, trading at discounts with growing cash flows.
You're steering clear of that one. We have an email from Don. What is Andrew's opinion on Allied Properties, AP.UN?
So Allied is also an office company focused in the Canadian market, concentrations in Toronto, in Montreal as well as out west, Calgary, Edmonton, Vancouver, about half the portfolio being in Toronto and some in Kitchener. The fundamentals have been really difficult. Allied's doing the best they can, blocking and tackling in a very challenged office market. We have vacancy rates quite high, occupancy levels probably in the 80% range across the broader market. Allied did a good job of selling off some data center assets to shore up their balance sheet, but then they took on some more assets from partner Westbank, some developments that they had, and had to put that capital to work. As a result, the balance sheet, the dividend coverage today, the distribution coverage is not as well covered as it once was. Some are concerned that if you stripped out some of the income that's attributed to some of these loans to Westbank, or if you stripped out some of the capitalized interest that they have, meaning developments that they've currently proceeding with, and hence they're not deducting that interest cost in their earnings, that they don't cover their distribution. In a tough market environment, it's very hard to get bullish on that type of setup, just as I talked about on the Brandywine setup. So not a name we're invested in today.
So a yield of about 10%, and yeah, so not a name that's drawing you. You would say there might be an asterisk next to the dividend sustainability. Okay, thanks very much. Mary in Burlington, Ontario, good to hear from you. Go ahead, please.
Hi, Andy. Hi, Andrew. Thank you so much for taking my call.
Pleasure.
Andrew, I'm wondering what you advise doing with European residential REIT now that it's starting to wind down. Thanks very much. I'll hang up and listen.
Yeah, so European residential REIT is doing the proper thing from a capital allocation perspective. The public market is not rewarding it with the full value of its apartment assets in the Netherlands, and hence it's winding down, selling assets piecemeal in the private market at very competitive values. And as of the end of the year, they had sold off about half of their portfolio and distributed that income to investors. Investors collected at $1.49 in a special distribution. So another half of the portfolio remains. Is about 3,000 suites trading. The value we think is north of 270,000 euros per unit. That would equate to their $3 IFRS NAV. So a name you can hold on to. I think there's a lot of value there. Management's doing the right thing and closing the gap by selling off assets and liquidating the trust. And I think you should just stay the course, and a name you can buy comfortably here.
But so they will keep going as a going concern, Andrew, or no, sorry.
No, they are selling assets one by one until the REIT is fully liquidated.
But it's not a bad investment right now.
No, because trading at the price it is below $2.50, arguably the assets are worth $3. You'll be able to collect that 50 cents.
Right, thanks. John in London, Ontario, go ahead, please.
Thanks, Andy. Looking forward to the Celestica CEO this afternoon. Thank you, Andrew, for Chartwell. We also own Allied and Choice Properties. What do you think of Choice Properties for an ad for the next 12 to 18 months? Thank you.
Thank you.
Yeah, Choice Properties is the name we own in the fund. Very defensive, trading at a nice discount. This is the largest REIT in Canada. Its assets are primarily leased to Loblaws, and being the one of the dominant grocers here in Canada, you can have a safe and secure tenant there. They also have a growing part of their portfolio in industrial warehouse, a sector we're quite bullish on, as well as some multifamily assets in their portfolio. The stock trades at a discount. It has a very safe, comfortable distribution. So I'd be very comfortable owning this over the next 12 to 18 months, as we think a broader REIT recovery should be near.
Okay. John, thanks for that question. Bill in Bowmanville, Ontario. Fire ahead, please.
Thank you for taking my call.
Pleasure.
I'd like your guest thoughts on Main Street equity, and does he see good things in the future. Thank you.
Thank you.
I do see good things in the future for Main Street. Also, a name that we own in the fund today. This is really a great story. It's not a REIT, it's a corporation. It never raises equity. It takes its retained cash flow, reinvests, buys more properties, up-finances the properties it has to continue to add value to its portfolio. Over half of the portfolio is in Alberta, another large concentration in British Columbia. We think this stock is quite undervalued. If you think about its concentration in Alberta, Alberta is benefiting from positive, really record migration into the province from other regions in Canada. And so Main Street will continue to benefit. So we think it's trading at a nice discount to net asset value in a sector that we like.
Okay, so it's drawing you. We're going to take a break. Andrew Moffs is our guest. He's Senior VP and Portfolio Manager at Vision Capital. The topic today, real estate stocks and REITs. We'll be right back. We have Alan from Montreal on the line. Go ahead, please.
Sure. Thank you very much for taking my call, Andrew. I'd like to ask Andrew's opinion on BSR REIT. I bought it on his recommendation about 4.5 years ago, and I'd like to know if it's still a good hold. Thank you again. I'll hang up.
Yeah, so BSR REIT is a multifamily apartment REIT concentrated in the United States in the Sun Belt. They have about 40% of its portfolio in Dallas, a quarter in Houston, another quarter or so in Austin, with some other assets in Oklahoma City and Little Rock. This name has, they've performed well. The backdrop is such that they've been up against a lot of new construction in their markets and a lot of new supply, and hence 2024 was a more difficult market environment for them in terms of the ability to raise rents. And hence, it, along with its multifamily peers in the United States, suffered with lower earnings growth last year, and hence the stock pulled back. Currently, the stock trades at a nice discount to its net asset value. If you own the stock and you like owning a company levered to the U.S. economy and perhaps U.S. dollars, this is not a bad name to own. So if you own it, I'd continue to hold on to it. I see a lot of value there. Earnings will not necessarily inflect this year materially, but I think over a longer term period, you should be in a good spot.
Let's head to Toronto. Luke is on the line. Go ahead, Luke, please.
Thanks, Andy. I wanted to ask about Northwest Healthcare REIT. Now that they cut the dividend, are they in a good financial position? And how soon do you see the stock getting back over $10?
Thanks.
Yeah, so Northwest Health are in a much better position today than they were previously. As you might be aware, they've gone through a bit of a management transition where the longtime founder and CEO moved on, and they had an interim CEO in his place. Unfortunately, that CEO has announced he's not going to be staying in the seat. So from a capital allocation perspective, it's very difficult to envision the stock going back to those $10 levels anytime soon, especially without a clear strategic direction laid out to investors. The company's doing a decent job today allocating capital, i.e. selling assets to pay down debt and perhaps move out of certain sectors that it moved into, geographies that it moved into, and righting the ship. Recent asset sales have provided enough liquidity for them to sufficiently pay their upcoming debentures, Series G debentures that mature in March. So from a liquidity perspective, all risk has been taken off the table. It's a buy and hold type of stock, if that's something you're looking at today. The risk reward isn't as compelling to sitting here today. I think some other sectors, this one focuses on medical office and hospitals globally. We find other sectors more compelling today.
Frank is in Mississauga, Ontario. Frank, you're on the air.
Hi, thanks for taking my call. My question is for Minto REIT. What's the issue with this REIT? I see the payout ratio is super low, and their book value per share is $27. At least that's what's published. and they are selling assets and redeploying the capital with higher growth areas, and also buying back their shares. Can you elaborate if you have any insights on this? Why this is keep going down and down? Thank you.
Okay, Minto.
Yeah, I think you actually did a very good job of summarizing what's happening with the company operationally. There really are no large hiccups at all. If anything, the company's doing a good job in terms of capital allocation.
And Andrew, can I cut you off for a second? We are talking about Minto Apartment REIT here, are we?
Yes, we are.
So okay, sorry. Carry on, please. I'm sorry to interrupt you.
No problem at all. They own apartments across Canada, concentration in Toronto, Ottawa, Montreal, as well as out west. Their apartment portfolio trades at a very wide discount to the private market value of its assets, i.e. its net asset value, its NAV. The issue with Minto is the macro. Canadian apartment fundamentals have been somewhat lackluster in the past year or two. Why? We've had tremendous population growth, but we're starting to see decelerating rental growth. Why is that happening? There's been a lot of competitive new supply, purpose-built rental that has come in, particularly in some of Minto's competing against some of Minto's core assets in Toronto. Condo inventory has also been a factor in terms of being competitive. But the real problem is that turnover is very low. Tenants, because of how unaffordable residential costs have been in Canada with all this population growth, tenants are loath to leave their current units. And with rent controls in the majority of Minto's markets, they're unable to increase the rents at the levels we all had been enjoying previously. The macro has been difficult. We're, by any account, any way you cut it, we're going to see modestly negative population growth in Canada in 2025 and 2026. That said, that's the glass half empty look. The glass half full look is that we're going to have material population growth relative to any year other than 2019 and the past 2 years. So we're going to see permanent residents in Canada still at 395,000. That's a big number. So I think the macro is hurting the stock. If you continue to own it, I think you're owning a very safe distribution, a very strong portfolio trading at a wide discount to NAV. You're just going to have to bide some time and wait for the economic picture to improve here in Canada.
We are going to take a break, and we're going to check out Andrew's past picks next. Andrew was on our show November 30th of last year. His first idea was Boardwalk REIT, the big apartment landlord, especially in Western Canada. This went down over the period.
Yeah, so Boardwalk REIT is a name we continue to own in the fund today. We think it's a great portfolio. The stock had a great run all the way up to our target price of $90. We set this target back in 2021. When the stock was trading in the $40 range. And so we enjoyed quite a ride. We took the opportunity once the stock hit our estimates of net asset value to pare down our position, but we've been buying it back at these attractive levels today. Why? This is an owner of affordable apartments, primarily in Western Canada. Alberta, as I mentioned before, seeing record migration from other parts of Canada, greater affordability in that market, and you're seeing strong earnings results continue out of Boardwalk, and it's exceptional value. You're basically buying this portfolio of apartments at $185,000 a door. We see trades most recently in Edmonton at $280,000 a door, Calgary $270,000 a door, and at just $240,000 a door, the stock's at $95. So we think it's a great opportunity on this pullback to start adding to this position again.
That's pretty cheap. So investors are valuing each apartment at about $200,000. It sounds low.
Absolutely. I think that's really the thesis, broadly speaking, about publicly traded real estate today. It's on sale. I've only seen this in my career a few times. This period of time is very similar to the .com lead up to the crash in 2000, where REITs were so unloved, but then went on to a period of time of 20% returns between the period of, call it 2000 and 2005. both on both sides of the border, Canada and the U.S. So I think, the public REITs are on sale. All you have to do is look to the private market and hopefully capture that arbitrage.
Let's move on. Chartwell Retirement Residences, CHS. A nice bounce on this one, a return of more than 50%.
Yeah, and we continue to see upside from here. Chartwell focuses on the retirement sector in Canada. It's a leading owner and operator, owns about 27,000 retirement suites. And their occupancy levels after plunging in the pandemic have now crept all the way over 90%. And some thought it was overly optimistic to get to hit their 95% goal, but we don't think it is. We think they can get there in the short to medium term. The demand profile is fantastic. You have over 4% CAGR in the over 80 years of age population over the next 20 years. Those baby boomers are retiring and they're looking for places to move to. And construction's at a near low, less than 1% of inventory. So great setup, cash flow recovery, and we think there's still a lot of upside to this stock.
Okay. And First Industrial Realty Trust, is this one of these warehouse/data center stocks, Andrew?
Not data centers, just purely industrial warehouse.
Okay.
They own warehouses in key markets across the United States. This was a big concentration in our fund for several years, as we thought it was the most highly discounted way to play industrial warehouse. It hit our estimates of net asset value around the fall last year, $56, $57, and we exited the stock then.
Okay, sorry, Andrew. What kind of turned you off the stock again?
Nothing turned us off. It's a great business, great management team, great assets. As soon as the public market value hits our estimate of the private market value, we seek to reallocate our capital.
Thank you very much. Okay, we're going to be back with Andrew Moffs. We always learn a lot about real estate from him. Senior VP and Portfolio Manager at Vision Capital. And the topic is real estate stocks and REITs. We got Sal on the line in Toronto. Go ahead, Sal, please.
Hi, thanks so much for taking my call. I had a question on Granite REIT, and I was interested to know what do you think of the prospects for this? And if you can also comment on whether if you think any potential Trump tariffs might have any impact on REITs such as this. Thanks so much.
Yeah. So Granite REIT owns industrial warehouses with concentrations in Canada, the United States, Europe. They have a very solid balance sheet. That's been one of the most attractive things about this entity. So pretty defensive on that. They have a concentration to Magna in Canada. They own a lot of their facilities as well as in Europe, in Graz in Austria, where Magna manufactures vehicles and vehicle parts. Granite REIT has had a bit of a setback last year. Some vacancy crept into its portfolio. The REIT tends to focus on what we call larger box warehouses, over 300,000 square feet. And those are taking longer to lease just due to some economic uncertainty on behalf of corporations that are taking a bit of a wait and see approach in terms of what's going to happen across the economy. Tariffs are the #1 question today globally. As I mentioned, Granite has a portfolio that has a large tenant concentration in Magna, which has a great tenant, great credit, very secure, dependable lease structure. But that, tariffs if they were to come to Canada, would certainly affect the automotive sector. Some might worry about the credit quality there. Similarly, in Europe, if there's tariffs coming in from goods from abroad, same sort of issues. And so one has to just put a bit of an equity risk premium today on certain Canadian securities as a result. I think broadly speaking, a trade in industrial warehouse, you have to think more about domestic consumption of goods as opposed to imports and exports. And hence, you can come up with a thesis that certain industrial warehouse companies will be more insulated to tariffs than others. Today, Granite, because of these vacancies, trades at a discount to its net asset value. It's a bit of a show me story, wait and see, buy and hold type of strategy. Today, we see perhaps a bit more value elsewhere, and we'll talk about that in terms of our top picks. If you're looking for an industrial warehouse play, in contrast, trading at a bit of a bigger discount.
Leonard is in Ancaster, Ontario, near Hamilton. Go ahead, please.
Thanks so much for taking my call, Andy. I had a question regarding another industrial REIT, Nexus, and I'm just wondering, it seems to be heading in the right direction with its FFO. There's lots of insider buying. Everything seems to be going right. What are your thoughts, and would you consider it a buy or a hold at this point?
Nexus REITs hasn't been one we've owned in the fund recently. They've been on a path to get to becoming a pure play industrial REIT. They own some retail and some some office assets, and they've done a good job by and large of selling those down. Some have worried about capital allocation, how they're putting to work some of that capital. I think while management's sound and operations are strong, it trades at a tighter discount than peers. So again, if you're looking for a way to play industrial in Canada, I'll talk about Dream Industrial a little later, but I'd look for something with more liquidity, perhaps something concentrated in more key markets. Nexus tends to concentrate itself in more secondary markets, which when the market was extremely tight, really benefited. Think smaller markets like London, Ontario. But today, I think your better risk reward is in larger cap, more liquid entities that even trade at wider discounts than Nexus currently.
Okay. Kevin is in Toronto. Go ahead, Kevin, please.
Good afternoon, gentlemen. Andrew, I'd like your thoughts on Canadian apartment properties. It's been trending down since last September. So I heard your comments earlier on Minto, and I'm assuming the same macro factors would affect Canadian apartment, but I'd just like to hear your specific analysis on this stock. Thank you.
Yeah, it's pretty similar. Cap REIT, being the largest apartment landlord, is the victim of anything that affects the macro. And given they have a more of a tilt to the higher end of the market, about 15% of their fair value is exposed to newer build product, they're seeing that softness more than others. You couple that with the highest exposure to the GTA, the Greater Toronto Area, amongst apartment REITs. That's about 37% of its portfolio, where we've seen pockets of new supply. And you've seen rental growth kind of stall somewhat. If you look at some of the rentals.ca data, rents in Toronto are below the national average. So if you're looking to invest in Canadian apartments, perhaps capital has gone to, besides the fact, broadly speaking, capital's left the sector. If they want to be invested in apartments, people have looked for markets that have had greater than the national average in terms of rental growth, markets like Halifax, markets like Edmonton. And so you've seen capital gravitate to names like Boardwalk REIT, which we've talked about earlier, or names like Killam Properties REIT instead.
Okay. Diane is in, and Andrew, can I just clarify something there? You said rents in Toronto versus the national average. You were referring to the rate of increase, or the, in fact, I think we've seen a decrease lately.
Correct, exactly. Year over year, we've seen increases. Quarter over quarter, we've seen decreases.
Right. Okay, Kevin, thanks for that question. Diane is in North York, Ontario. Go ahead, please.
Hi, I'd like to know about, excuse me, the InterRent REIT. I own some, and I'm thinking to add some more, and I just would like to know your guest opinion on that. Thank you. I'll hang up and listen.
Thanks.
Yeah, so InterRent, very similar story to Minto, very similar story to Cap REIT. Again, they're apartments concentrated heavily in Ontario and Quebec markets where rent controls have limited their ability to increase rents. And that coupled with the macro of softer population growth, fewer foreign students. InterRent does have a bit of a concentration in downtown Montreal, and with the federal government limiting non-permanent residents and foreign workers as well as foreign students, that has taken some demand away from their markets. And so, again, you can't expect the same internal growth rates we've seen previously, but at these levels, arguably the stock's trading at quite a discount, similar to Minto, similar to Canadian Apartment REIT, but then similar to Boardwalk and Killam, all good names. So now you really have the choice of where you want to invest. Again, we think, broadly speaking, there's a Canadian REIT recovery underway. Capital should be returning to the sector, and when it does, I think the apartment sector should win out.
Thank you very much for that question. We're going to be back with Andrew Moffs, Senior VP and Portfolio Manager at Vision Capital, taking questions on real estate stocks and REITs. We have an email here from Anurag. Should I hold Starwood property purely for income, or is there potential for capital appreciation?
I would put Starwood Property Trust in the income bucket. Its dividend yield is in the high 9s currently. It's externally managed REIT managed by Starwood Capital Group, one of the world's largest real estate private equity firms globally. They use the Starwood Property Trust vehicle to originate new loans as well as invest in CMBS securities, and they do a good job of it. In order for earnings to inflect, you need to see originations increase. We perhaps might be going into that type of environment where transactions will pick up and Starwood can gain either greater market share or just simply participate as volumes increase. But really, if you're going to hold this stock as a mortgage REIT, you're just looking to capture the spread between the interest income they earn on making these loans and after expenses, then you're just trying to collect that dividend. And so that's why I would own this stock. And I think you're pretty much in a secure part of the market today. I talked about how there's a sustained commercial real estate recovery underway. So I would think that with a pretty good borrower base, I think Starwood is a pretty good allocator of capital, and you should feel comfortable owning these shares.
Okay, thanks for that question. We have an email from Mark. Could I get your opinion on Artis REIT, AX.UN?
Artis REIT's a difficult company to analyze, and today it's really a company in transition. They concluded a strategic review whereby they were looking at selling off their assets to try and close the gap between net asset value and the trust's unit price. What you're making a call here is how sustainable the distribution is. Currently, a lot of its income comes from an investment they made in a company called Cominar, which doesn't pay it cash. It pays in kind, meaning they will pay them in the future, but investors have to count that non-cash payment in the income in order to justify the distribution. If you basically cut through that accounting noise, the REIT isn't covering its distribution. So institutional capital has really left this security. It's really a retail investor base that's owning it, hoping that that distribution cut doesn't come, basically hoping that the Cominar investment will be able to pay off the shortfall in cash in the future. Not a name we're focused on today.
Michael in Toronto, go ahead, please.
Bonjour, hello, Andy and Andrew. Thank you for taking my call. My question is on RioCan REIT. Andrew, would you be buying this REIT? If not, what would you recommend? Thank you, merci.
Yeah, I think RioCan is, like a lot of its peers, at a very attractive level currently. They own a really great portfolio of shopping centers across Canada. They have a growing portfolio of multifamily residential. And quite frankly, the company thinks they're not getting full value for it and is actually looking at ways to perhaps sell their interest in some of these newly built multifamily apartment buildings and reallocate that capital towards retail or buy back debt or retire, buy back shares. The overhang on the stock today has been the fact that they have about $600 million worth of condos that are closing over the next 3 years. The market's written those down to zero, notwithstanding they hold on to 90% of them have been pre-sold, and they hold on to the deposits. That deposits of the rate is about 18.5% of the value of those condos. So material dollars, $150,000, the average deposit for someone to walk away from their condo. I personally don't see that happening, but the market has spoken and has put a bit of an overhang on this stock that we think is unwarranted. So I think the risk reward is in your favor to look to buy this stock here, trading at a pretty decent high double-digit discount to net asset value.
Steve in Waterloo, Ontario. Go ahead, please.
Good afternoon, gentlemen. Thanks for taking my call.
Pleasure.
I'm looking to slightly diversify my real estate and REIT holdings between some industrial and residentials. And I was looking at smart centers as a potential option, but in addition to the RioCan comments that you just made, what should I be looking at in terms of the yield, sustainability, and how the current trends in the industry and business world are going to affect how smart centers' outlook will be going forward? Thanks very much. Have a great day.
Yeah, so great question. Two very different investment vehicles, notwithstanding they both operate in the retail sector. Smart centers is more geared towards the open air power centers, where most of their centers are anchored by Walmart, which is a very secure tenant, great cash flow. Hence, people invest in this stock for its high distribution yield of over mid-sevens. The issue with smart centers today is not about operations per se. It's about the balance sheet. They are going into a few years of retiring low-cost debt. And as a result, earnings growth will actually be negative. If you looked at a CAGR over a 3-year period through 2026, you'll see negative FFO growth. So it's typically not something we look to. We like to see, as part of our total return, something beyond the yield. If you're looking in the shopping center space, I'll be talking about First Capital and our top picks. That's a great way to have both income while you wait, but capital appreciation in the form of either closing the gap to net asset value or higher cash flow growth.
Anita, one of our regulars, is in Markham. Go ahead, Anita, please.
I love this show.
Thank you.
Thank you so much for taking my call. My question is on CT REIT. I'm just going to have your thoughts on this company, please. Thank you.
Sure. So CT REIT is a portfolio that consists primarily of Canadian Tire anchored single-tenant stores and shopping centers. That over 90% of the rent comes from Canadian Tire. So as you can imagine, a very secure cash flow being paid from the tenant to the REIT, and hence the distribution to investors. So if you own this, you're owning it for that very secure 6.5% yield. Internal growth has actually tracked about the 2.5% internally over the past 2 years, but decelerated most recently in 2024. That's, we think, will be just a short-term, some short-term noise. The portfolio is over 99% occupied, so I'm not worried at all in that respect. I think this is just a safe security you continue to own, not necessarily for the capital appreciation, but again, for the distribution plus call 2% growth on top of it.
We are going to take a break here, and we're going to get Andrew's top pick. Andrew's first idea is First Capital REIT, FCR.UN in Toronto. And Andrew, just remind us, what is their business model?
Their business model is to own the finest grocery-anchored, necessity-based retail real estate across Canada. They concentrated in urban centers, and they own over 22 million square feet of these high-quality shopping centers. They have a further 23 million square feet of potential future density that they can build incremental to their existing retail base. And we believe it's the best, highest quality grocery-anchored shopping center portfolio globally. We have the ability to buy such high quality assets at a very large 30% discount to net asset value. We think it's attractive. It has an attractive 5.3% distribution yield. So you get paid while you wait, while that value gap closes. The company set out a 3-year strategic plan to grow earnings and net asset value 3% annually over the next 3 years. They've set out a plan to monetize some of that density value that they have and reinvest it in their portfolio, where they can either buy back stock or reinvest in their assets and garner higher yields. So we think there's a great opportunity to own defensive real estate with growth here and get paid while you wait.
Okay, we got Dream Industrial REIT as your next idea.
Yeah, so I've talked about the industrial warehouse space. Dream focuses on this space, but what they do differently is they focus on something we call the small and mid-bay segment, meaning warehouses that are in that 20,000 to 140,000 square foot range. These are typically urban distribution warehouses and logistics assets that we find across Canada. About 2/3 of their portfolio is concentrated in Canada and another third in Europe. They also have a partnership with the government of Singapore, where they acquired Summit Industrial REIT and they developed assets in that vehicle with them. We think this urban concentrated portfolio is somewhat immune to new supply. The higher and better use of many of their assets is perhaps not even warehouse. It's probably things like data centers, or could even be residential in some places. We think as a result, you'll continue to see earnings growth, and it trades at a very wide 28% discount to our estimate of value. And we think that's in the 16.5 range.
Okay. And finally, Sienna Senior Living, feeding into that demographic theme once again.
Yeah, it's very compelling supply and demand fundamentals, as I talked about with Chartwell, really applies to Sienna on their half of the portfolio that's in the retirement sector that continues to recover nicely. They also operate in the long-term care sector, where they operate nursing homes in Ontario, where we see 40,000, 50,000 person waiting lists. I think this management team has done a phenomenal job operating through what was a very challenging market just a few years ago throughout the pandemic. They've developed great relationships with the government, and they're led by a very strong board as well. Stock trades at a big discount to its net asset value, with, like I've talked about, a very compelling tailwind of seniors population growth, and they're on track to higher occupancies as a result. So we've taken advantage of this pullback to add to our exposure in Sienna, and think it's a really great play with over 6% distribution yield while you wait and see that earnings increase.
What could go wrong for the senior living and senior care category? I guess oversupply ultimately would be a risk.
That's been the number one risk, really, for any real estate asset class, but certainly prior to the pandemic, we saw construction starts 2-3% of inventory, and that really hampers the ability to increase rents and retain, as you have turnover, attract new tenants. Today, given where interest rates move to, it's really been prohibitive for new construction. And if anything, Sienna and both Sienna and Chartwell are taking advantage of that environment, and they have land where they can develop at a lower cost than other competitors in the market.
Yeah, sometimes I fantasize about that, living in one of those places, no maintenance, go down and get my meals cooked. But the thing that would worry me would be all the other old people there. I think they get on my nerves. Anyway, Andrew, we better leave it there. Thank you very much indeed.
Thanks for having me. Appreciate it.
Andrew Moffs.